Hello and welcome to this Monetary Policy Special. I'm Latha Venkatesh. The minutes of the last Monetary Policy meeting held on 8th August indicate that at least two external members of the MPC hugely disagree with the majority view and the Reserve Bank view. Dr. Jayanth Varma and Dr. Ashima Goyal argue quite strongly, according to the minutes, that India's potential growth is probably higher. In fact, Jayanth Varma says it is 8%, and that the restrictive rate policy of the Reserve Bank, high real rates, is actually slowing the economy. Dr. Goyal extremely strongly suggesting that high real rates can create social tensions and lower jobs. However, Governor Das, on the other hand, representing the bulk of the Reserve Bank view, says that India's economic growth is fine, and that gives the Reserve Bank and the MPC the space to chase down inflation to the given target of 4%, the mandated target of 4%, which both of them argue has remained elusive. So clearly, those are the two opposing sides. To take the discussion forward, I'm joined now by the external members, Dr. Jayanth Varma, Dr. Shashanka Bhide, and Dr. Ashima Goyal. Gentlemen and Ashima, thank you very much for joining us on the show today. This is the last of the MPC meetings that you will be members of, so this conversation becomes special. Let me start with Ashima. Ashima, you're arguing that the restrictive policy, that is the very high difference between repo rate and the current inflation working out to over 2%, maybe 2.1%, is likely to spark even social tensions and lower jobs?
No, I'm saying that we need to grow at our potential. Our potential is higher. We need to increase the rate of job creation to the maximum that we can. And therefore, monetary policy should not be reducing the growth below its potential. Mm-hmm. That's important.
No, the natural, interest real rate argument presented in the July bulletin is that, the country's potential is actually 7%. So, you can't really argue, going by that argument, that we are below potential at this point in time.
No. So there are a lot of controversies about measuring potential growth and the equilibrium real rate. And I've given some arguments why the RBI has not included some factors related to the structural growth transition path we are on. That would actually reduce the equilibrium real rate. But the argument I'm making is that, all right, estimation is difficult to agree with, but just look at the outcomes. Like if core trend inflation is downwards, it's at 3% core inflation, below the target, right? That means that we are not at potential. We can grow faster without raising inflation.
Yes. No, I take your point that core inflation is one parameter that is indicating that perhaps growth isn't very good. But if you look at a whole host of other parameters, including PMI, including GDP numbers up to the last quarter available, it gives a slightly divergent picture. I'm coming back to you in a minute. Dr. Varma, you are arguing that the whole idea of potential growth at 7% is wrong, underestimated.
Absolutely, because we are at the stage of our economic growth where we need to grow much faster and we have the ability to grow much faster. We have to recognize that we are at the stage, in the demographic cycle where a very large number of young people are entering the workforce every year. And this demographic the demographic benefit for us will last for another decade or more before the demographic transition reverse and so on. At this point where so many people are entering the workforce, it is possible to grow in a non-inflationary manner at much higher rates because there is that workforce ready to be absorbed. And you can give them jobs without putting upward pressure on wages and input costs and so on. And the other barrier to rapid growth would have been, issues like infrastructure and so on, which again, the reforms of the last few years have addressed many of that. We have had significant investment in public infrastructure, digital. All of this means that the economy is capable of growing much faster. It needs to grow much faster. And I think the correct benchmark is not to look at how other economies are growing today. Today, most of the large economies are well past their demographic transition. China's population is actually declining. We got to ask the question, how fast were those economies growing when they were at the same stage of our demographic cycle? When their workforce was growing, how fast was that growing? China was growing at 11, 12%. That is the growth rate that an economy is capable of when there is a flood of new workers entering the workforce. And you don't need to pay higher wages to absorb that. So that is the kind of horizon we must have. That double-digit growth is what we should aspire for. And even if we think that that would require more reforms, even the reforms that have been done already should be able to push you to 8.
Okay. Well, this is an argument that keeps coming up, and the economic survey doesn't buy this argument. In fact, Ananta Nageshwaran repeatedly says we are not in the global situation that China was in the early 90s. But that argument a little later. I want to come to you with other questions on monetary policy. But first, Dr. Bhide, your overall macroeconomic assessment is that growth is fairly strong. So why meddle with it? Let's concentrate on the mandate. Is that the broad thesis?
Yeah, yes. So I guess, in this meeting, also the projected growth rate is about 7%. And I think, one of the things that especially I think is important is that on the supply side, I guess, we do see those bright spots, which are opportunities for raising output growth rate. But I think we should also be concerned about the immediate demand situation. And I think so the growth that has happened in the last year and probably projections for the present year also are looking at the prospects for investment growth and consumption. And I think it is important to recognize that, on both these projections, there are risks associated with that. And therefore, I think it's not the supply side alone. I think that is important looking at the growth rate. In that context, 7% growth rate appears to be fairly strong growth at this point. So I think, if we need to raise the 7% growth to 8%, I don't think the present demand conditions support that.
Yeah, that would be, especially because we have a long way to go in terms of employment. But Dr. Varma, to come back to your question about this real interest rate being almost as high as 2.1, because the 1 year ahead inflation, which Reserve Bank has forecast, is 4.4. The current repo rate is 6.5. So it's effectively a 2.1 real interest rate, which you argue is too restrictive. But, when you look at financial conditions, and even when we speak to heads of corporates, which we do on a regular basis, no one complains of any tightness. Look at the way the stock markets are running away. Look at the amount of money going into F&O. People seem to be having too much money. The Reserve Bank is rightly worried about unsecured loans getting too much of attention from banks, and therefore asset quality dwindling. All these don't show tight monetary policy conditions, do they?
Asset markets have a logic of their own, and monetary policy cannot be hostage to asset markets. Asset markets are swayed by global factors, and there is a global, risk-on appetite at this moment, which is driving asset prices across the board, across multiple countries. Now, that does not tell us anything about whether monetary policy is restrictive or not. The question is that we have to ask is what is happening on private sector capex? If the situation is so bullish, why is private sector capex not happening? For the last more than a year, the thought has always been, private sector capex will happen next quarter. It is just there on the horizon. And we have been waiting for Godot. We have been waiting for 4 quarters, 6 quarters. It has not happened. And at some point, as I state in my, in my statement, hope is not a strategy. You can't just keep hoping that capex will revive. You got to ask the question, yes, what are the conditions required for that capex to happen. And the condition required for that capex to happen is that demand has to be there and capital has to be sufficiently attractive. And a very high real rate makes capex unattractive to the corporate. And if demand is inadequate, that also does that. And restrictive monetary policy is one of the things driving demand as well. You know, when your EMI goes up, every rupee that your EMI goes up is 1 rupee less available for consumption. And if we think that demand is deficient, that the economy requires very large fiscal support because private demand, you know, the private consumption expenditure is not growing, then we have to ask, what have we done? Is monetary policy part of the problem? And I think we have to at some stage ask whether monetary policy is too restrictive. Is it too restrictive at a point where inflation is so close to target? See, remember, I would not ask this question if inflation were running at 5.5%. But when inflation is so close to target, you got to ask the question, how much of growth sacrifice are you willing to pay for accelerating that last 40 basis points of decline? That is the question. There's no question about the destination we have to hit for. That is granted. But the question is, what price are you willing to pay to do that 1 quarter earlier than before?
Ashima, what is your telling argument, the key clinching argument that made you vote for a rate cut?
I think there is room for a rate cut, that we need to follow flexible inflation targeting. And that means keeping the rate at the minimum that will deliver our target and maximize growth towards potential. And this is the principle underlying the kind of coordination we've had, which has delivered very effective, made India one of the fastest growing, largest economies, the most stable macro in the last 3 years. The government is taking enough supply side action to help the RBI keep inflation approaching its target within the tolerance bands. Yeah. And this, like Shashank was saying, that the demand is not enough to give 8% growth. Now, you know that the elasticity of demand is very high in India because we have so many young people who are buying houses and have to equip them with consumer durable on credit and so on. And you might say that financial credit is booming, etc. But then the RBI is doing something very clever, which is to target areas where credit is growing too high with prudential regulation,
No, but yeah, I agree with you that you don't have to hike rates to bring down unsecured credit or one specific area. But at the same time, the very fact that unsecured credit is booming, the Reserve Bank had to come down heavily on even P2P lending. These anecdotal evidence don't give the sense that the economy is tight, does it? It seems to give the impression that more credit is available than people can pay back.
No, so this is, as I said, the interest elasticity of demand is very high. If the real rate is reduced, it will increase demand further. And it so happens that given our structure, monetary policy affects demand more because the other thing is the budget deficit it's conservative. It's on the fiscal consolidation part. So the excess demand stimulus from government is going down. And so there's space for monetary policy to support demand more. And we're not using that space. So we are restraining growth. Demand is not enough to take our growth to 8%. Growth has come down 1% compared to what it was last year. Yeah. And this last Q1, there's been a lot of signals of softness. We saw with the US Fed also, when you ignore sort of signals, negative signals, you can be faced with a big event.
Well, actually, the pendulum has swung and now it looks like there are as many positive signals as there are negative signals. The non-farm payroll probably swept us all away, but thereafter we've got retail sales, which if anything is indicating that the economy is not all that bad as the unemployment indicated. But, I have to take a mandatory break. I'm back with more advice and takeaways from you as you wind up on your last meeting of the MPC as external members. I'm back in a minute.